Hi and welcome back to Order Flow Mastery Session Dynamics 104. In this lesson, we'll take a look at the initial balance breakout, which is one of the highest performing historically price action, let's say, patterns, or let's say statistically valid edge in the markets. And the initial balance breakout is something very simple. It basically takes the first 15 minutes or 30 minutes or 60 minutes of the session. It takes that range or that candle, plots the high, plots the low, and whenever there's a candle breaking out from that at the lower time frame, for example 5-minute time frame, you buy or you sell. This is a very, I would say not very, but decently old strategy invented in the 1990s that has demonstrated to have a very consistent edge throughout decades. Okay, this is one example. This is a 5-minute chart, so you count 1. This is the first candle. 2, 3. These are your 15 minutes. You take the high, you take the low, and you trade the breakout, and that's a good trade. And this is the performance of a opening range breakout strategy, risking 2% per trade, compared to the performance of just buying and holding the S&P 500, started from 2021 till more or less today. And you can see that it has a better Sharpe ratio, a smoother equity line, and a clear edge, especially in times of very directional markets. In periods where maybe market are not that directional, then this might suffer. And you could have, entire years where the performance is not great. This is a long-term perspective. Okay, so this is just a bias, right? More or less 70% of the time when there's an opening range breakout, you have some level of excursion, okay? It's not 100%, guys. It's not 100%. So if you're going to use this type of model that then Fabio has put on steroids with the IVB model, which is the initial volume breakout that he will explain to you, and that is available in the Deep Charts full version, don't expect a 100% win rate. There can be long periods of time where you don't see a lot of profit. That's completely normal, because that's, a different type. This is a very mechanical edge, right? But with the right context, with volume analysis, with order flow, you can qualify breakouts in a way that just by looking at candles, you simply can't. Because the money will tell us if that breakout will hold or not. But it's an edge that has a consistency, a very mechanical base, because it's a very easy strategy. It's no big deal, but that you can build on top of that your discretional narrative thanks to real order flow data. So let's take the last session as an example. So the first 15 minutes, we had, this is the low, and this 45, this as the high of the opening range. So this is our opening range. And what you want to see is a breakout above, and the breakout happens. Let's put ourselves in the 5-minute time frame just to have. So I'm going to load my favorite 5-minute template. So for example, we take a look at what the volume does above here in the 5 minutes. And we might see that there's a lot of aggressive selling that is completely and utterly absorbed. So there's a lot of volume, right? Volume is increasing. There's a lot of volume activity, which means interest, which means participation, which means the smart money's there. But look at what happened. Yeah, it's all purple, but why? Because look at this, all of this absorption of sellers. Sellers trying to go here, but they were completely absorbed from buyers. So buyers are more active on the passive side. They completely absorb all sorts of seller, and that's a very clear indication that this breakout is very likely going to continue. And there you go. Again, also here, absorption at the bottoms, exhaustion, big imbalance. Again, at the top, a lot of sellers. What happens to them? They're all absorbed. This is the clearest you can get on market mechanics. And this is how you can take something very basic as a opening range breakout or an initial volume breakout, an initial balance, and thanks to volume, being able to take advantage of that with a very, very, very clear bias to begin with.